record the. Thank you, Angela. If you have questions at all during the workshop, please don't hesitate to ask. You can put it in the chat. If you would like, you can also turn your microphone on and just ask a question at any of the pauses. We are really excited today to have with us Jennifer Barnes. She's one of our favorite presenters. She's the CEO of Optima Office. She is just an amazing person to work with, a person to work for. I see that you keep winning the awards for the best company to work for. And she was telling how she's taking 100 of her employees for a big baseball extravaganza. I can see why people love working with you. So at any rate, I'll pass it on. I'm sorry we got started a little bit late today. Thank you guys for sticking with us. And we're going to go ahead and just jump right in, dive right in, and take it away, Jennifer.
Cool. Do we have this, the slides?
Slides, yes.
Want to share?
That's right.
To share
Of course. Absolutely.
Never mind, actually, I changed mine.
Okay, no worries. So perfect. And you'll go ahead and pin this one? Perfect. And can you hear us all right?
Just go to this thing. Oh, yeah, you got it.
Yeah. All right. Can everybody see her slides now? Oh, they disappeared. All right, give us a second here. Oh, okay. And this is the way it looks to them. So.
Oh, okay.
Okay, perfect.
Cool.
And but you can see them.
I can just go like this to click it, right?
Exactly.
Okay,
Good to
good.
go?
All
Okay.
right, we're good. Hi, everybody.
Awesome.
I matched my slides. I have the blue background and my blue shirt. Not do that on purpose, but oh yeah, you got the memo. Perfect. Well, hopefully everybody is ready to learn about small business accounting and also startup accounting. And actually, this is just accounting for any business, but we'll focus a little more basics on businesses who are just starting off and things to keep in mind. This is just a quick bio about me. I'm on my second company. We're doing pretty great at Optima. We've got about 90 W-2 employees, and our fourth year in business, we'll do close to 10 million. And we provide CFO services and outsourced accounting, controllers, bookkeeping, human resources, and it is such a needed service in the industries right now. Companies that, don't want their bookkeeper being their CFO, because that never makes any sense. And you certainly don't want your CFO to do any bookkeeping work. So that's what we do. And it's been fun. We got about 300 clients that we work with, from nonprofits to professional services to manufacturing, distribution, restaurants, retail, pretty much help them all. So I'm really enjoying what we're doing. Now, I want to ask some questions of the group on this next slide, but I want to go over what are the basics of financial management in order to manage a small business. So why is it important for all of you, as you're learning to be entrepreneurs, or maybe you've already started your entrepreneurial venture? Why is it important to understand financial management? What's important about financial management? And I want you to also know which are the main financial statements. You've probably learned some of this in Tanya's classes already, that what are the main financial statements that you should really just know how to read. I always like to start with the balance sheet, because you should understand your balance sheet. You want to own more than you owe. That's the key. So more assets than liabilities. And then what are some basic financial definitions? We'll just go over some real basic ones. And what are some important ratios that you should know as a business owner and as you're embarking on your business owner journey? And anybody that's going to be a business owner, you need to understand the basics of bookkeeping. Hopefully none of you are going to be doing your own bookkeeping yourself, because that's usually not a good use of your time. Your time should be focused on earning revenue in your business and being your rainmaker, not crunching the numbers. Yeah. Rainmake it all the way, people. And then my very favorite, why should you budget, and what's important about a cash flow forecast? I will say that the two are very, very different. Your budget should be really focused on your profit and loss statement. And there are so many things that you are going to spend money on in a business that are not going to go on your profit and loss statement. You might have a loan that you pay principal on. You might have distributions as a shareholder. You might be buying assets, which go on your balance sheet. You might be prepaying for expenses, which also go on your balance sheet. And so when you're looking at cash that's spent, make sure that you're focusing on what actually goes on my balance sheet, what's an asset or liability versus what is revenue or an actual general and administrative operating expense, cost of goods sold. And many people try to take their budget and their cash flow and align them. And that's when they start running out of money, or they start thinking, oh my God, I'm so profitable, and they might not be. So those are things I want to focus on today. So I'll open it up to the group, the ones that are here and also in chat. Why is it important to have good financials?
For filing your taxes, keeping
Yep.
a record.
And then people on, can we hear the people on?
Yeah, I'm looking here.
Okay, I
So
don't
it
know if
says, need to know if you are profitable.
Absolutely. You definitely want to know if you're profitable. And does anybody know some of the most important reports that you should have as a small business? Ones that you should really know how to read? Got it. And I'll add on budget actual, because it's kind of nice to know the score. It's kind of, I mean, those are the three main ones that you listed. But I'm also going to add that as you become a business owner, it's not just, you know, you're in the classroom and you understand how to read a balance sheet and a P&L. How do you put it into practice? By putting together a budget that you can follow and then comparing it to the actuals. Yeah, that's also important to have good financials so that your CPA doesn't pull their hair out. Because oftentimes people, entrepreneurs, give their financials over to a CPA, and the poor CPA has a million audit adjustments. And if they ever did a fixed fee return for you, and then they have a bunch of changes that need to get made next year, you might not get so lucky. They might triple the cost. So make sure you have good financial reports. And then lastly, I love this question. It's not a trick question, but if you made $50,000 this year in profit on your income statement, but you didn't pay yourself, are you still profitable? No. No, you're not. And let me tell you, there are some horror stories, especially when you start having investors, that you can have investors in your business, your sweat equity, right? You're working for free. You're not paying yourself. Well, then your company doubles and triples in size. Well, that was never recorded. You didn't put deferred salary on the books. Whether you have the cash to pay yourself or not is irrelevant. You always want to make sure that you're recording owner's salary, whether you're hourly and you're making $60,000 a year, or whether you want to record the fact that in the market you could be earning $100,000 a year. So your salary, if it's $100,000 a year, you're not paying it to yourself, you're not recording it, but you're $50,000 profitable per books, you're actually $50,000 negative. So make sure that you are always paying yourself. If it can't be in cash, at least put it on the books. I have seen people devastated because they've built million-dollar businesses, multi-million-dollar businesses. They never recorded their pay. They worked for practically nothing. And then the investors are going to take their portion, and they're not going to give you anything that's not recorded on the balance sheet. So I just want to stress that it's important. Understanding financial management really helps you understand what you can afford. Also, can you go into a new office lease? If you're a manufacturing plant, should you go into a 3PL? How much inventory can you have on stock on hand? What kind of equipment can you buy? How much can you pay your employees? Can you afford to have a new employee? And so the more you understand about your financials, the more that's going to help you run a successful business. It helps you understand if you're profitable. I think somebody in the room said, making sure that you're profitable is important. And then it can also help you find the right direction that you're going in. Are you staying steady? Are you going up? Are you going down? Are you hitting your break even? I would always recommend that you at least aim to break even. You can be in a loss for a few years as a startup, but you want to have a plan not to be in a loss and to be able to either pay investors back or pay yourself back and get yourself into a steady state sooner than later. So the main financial statements, and this man over here listed the first three: profit and loss, balance sheet, statement of cash flows, and budget versus actual are the four that I like to focus on. I do want to make one quick point, as a statement of cash flows is not the same thing as a cash flow forecast. So make sure you know the difference between those two. Let's look at the profit and loss and also the balance sheet, kind of the key components to both of these statements. We're not going to go over a statement of cash flows or budget to actual today, because I think people, that's fairly, that's textbook. You guys can look at that kind of stuff yourselves. But I also wanted to at least give you the basics on your sales minus your cost of goods sold is your gross profit. And I see a lot of people make mistakes on what their cost of goods sold are. So anything that helps you to earn that revenue that you're going to almost variable based on how much revenue is coming in is going to be your cost of sales. Some people don't put merchant services on there, but if your clients are paying via a credit card and you're paying merchant services, that is part of your cost of sales, your cost of services. If you're a professional services company and you have people, then your people are always going to be a part of your cost of goods sold, including their payroll taxes, any 401k, health, dental, medical, any overhead that you have associated with people that are earning revenue on your behalf of the company are going to be in your cost of goods sold. I see a lot of people take their payroll reports and they put employee cost salaries above the line and cost of sales. And then they take the payroll tax portion of it, some of it, even the payroll tax that their employees are paying, and they put it below the line. That's crazy, because that's the same thing. You have to include payroll taxes and everything, all the overhead that it takes to have an employee. You need to put that as part of your cost of goods sold. If you're selling products, the cost to make the product has to be put into your cost of sales. Now, anything fixed, rent, facilities, internet, phone, marketing costs, those are all costs, professional fees, legal fees. Those are all fees you're going to have to pay whether you have $1 in revenue or not. So think of it as that way. If I'm going to have $1 in revenue because of this, then that's probably a cost of sale. And if it's a fixed cost, and no matter how much revenue you earn, the cost isn't going to change. That's going to be below line in terms of a general and administrative cost. Moving on to the balance sheet. Assets are everything you own, right? And if it's liquid, that means it's a current asset. You could liquidate it within 1 year. And anything longer than 1 year is going to be either a fixed asset or a long-term asset, something that's more of a longer term, something you still own it, but it might not be liquid anytime soon. Same with liabilities. Your current liabilities or anyone you have to pay within 1 year. And I had mentioned earlier, you always want your assets to be greater than your liabilities. Otherwise, you start getting into insolvency. And the longer you're insolvent, the more risky it becomes. So I've always really focused on how can we maybe not double the amount of assets as liabilities, but at least maybe a 1.25 ratio or higher, which is called your current ratio. I believe that's in my key performance indicator ratio slides coming up. Any questions on P&L balance sheet before we move on? Yeah, I think that you probably cover this in your class too. So we don't want to get too boring here. Let's talk about some financial statement definitions. I know that I'm talking about accounting to a bunch of entrepreneurs who want to focus on their product or their service, and accounting is boring. So I put some memes in here so that at least it's a little more entertaining. Okay, sure, great.
I'm going to hold off on the nonprofit one because I know that accounting is a little different than what you're talking about here for startups.
Okay.
But there's one that says, can you define operating income and why is it important?
Well, operating income is going to be after your sales, less cost of goods sold. That's then your gross margin. And then you're going to have all of your operating costs and then your operating income. So you want, even if a bank is going to give you financing, you want to have positive operating income. That's essentially positive EBITDA, earnings before interest, tax, depreciation, amortization. And so all those things I just listed are going to be below the line. And, you can back those in and out for tax purposes, but operating income is what you want to focus on. If you have a ton of depreciation because you have a bunch of equipment, that's not necessarily something that a bank's going to focus on when they're giving you a loan, or an investors are going to look at. They're going to what is this company earning in terms of operations?
I guess I could ask you about the nonprofit at the end.
Okay, sure.
Thanks.
Yeah. I already went over gross margin, but just putting it up here as something, the difference between what you're selling and the cost to deliver the product. Operating margin, we just talked about that. And then profit margin, you're going to just divide your company's net income by its revenues. So your net operating income divided by your revenues is your profit margin. Now that's going to vary, and there's no easy answer. It could be 1%, and that might be great, or it could be 20%, and that might be bad. So you want to compare it to industry benchmarks. What are your competitors doing? What is normal profit margin in your industry? I run a professional services company. My people cost me almost 80% of our revenue. We also pay very well. We treat people very well. We want to make sure we have a 401k match, health, dental, vision. High retention is my priority. And so our operating income might be 7% on $10 million. And I'm fine with that. That's the way my business operates.
So actually, when you're talking about this, can I just interject?
Yeah.
So a couple of the people were asking about, specifically what services your firm offers. And I'm glad that you talked about your commitment to your employees. Do you also, or do you have any outreach or any emphasis in your firm with working with diverse groups as well, for companies that are diverse or minority founders?
Yeah. We have a ton. I mean, we have 300 clients. They are all across the spectrum, and our employees are across the spectrum. I mean, I think we have every single race, gender, everything covered, industry, service lines. We do everything from the bookkeeping, the easy data entry, expense coding, bookkeeping. That's easy, right? I have a dozen bookkeepers. We can do that kind of work in our sleep, but people usually like us for the higher level work, cash flow forecasting, budgeting, analysis, what's driving your business, how do you become more profitable, those real financial analysis type of things.
And then somebody else asked about the HR in your firm. So
Right.
I didn't know that you actually did HR.
Okay.
What do you do with that? What do you do with that?
Yeah, HR is, I have always felt, because we're one of the few companies that offer both services in terms of accounting and HR. And a lot of people are either want to focus on human resources or they want to focus on accounting. Well, we feel that they really go well together, because if you're putting payroll in to a company's QuickBooks file or to your NetSuite account or whatever software you use, you still want really qualified human resource people to verify that the payroll numbers are correct, that you're paying people per California or Nebraska law, whatever state you're in. And there's a lot of employee benefit questions, and there's a lot of questions that come up with our clients that we feel that our accounting and our HR services really intertwine one another, and they help support each other. And it just makes it nice to have under one roof. But we do everything from employee handbooks to compliance to, should somebody be a 1099 or W-2? How do you set up employees properly? How do you give them benefits? How do you hire them? How do you fire them? How do you onboard them? How do you manage them? I think employee retention is huge. Great resignation, right? Everyone's heard that word. I'm kind of sick of the word, to be quite honest, because I feel like it was a really big 2021 issue. We're not seeing as much of it in 2022. I feel like people have somewhat settled down to where they're going to be. But if you don't have a good employee relations program and your employees aren't happy, and you're not constantly focused on what your employees want, then turnover is extremely expensive. So we had about, let's call it 22% turnover last year, which is really high for my firm. I'm typically in the 15% range at the most. We don't like to lose people. And oftentimes when we do, it's because our clients fall in love with them and hire them, and I charge them a big fee. I'd rather have the employee than the fee though. But yeah, anything HR that goes along with accounting. And then we recently started helping with operations, because there's a lot of operational metrics that you should focus on in your business. And some of those might be utilization. If you have a professional services company, you might want to understand some of the key performance indicators that go along with manufacturing or inventory and those types of things that are more operational in nature than they are accounting in nature, but you want the two departments to talk to each other. And a lot of companies don't need a full-time COO, director of operations. They might only need somebody 10 hours a week. So yeah, hopefully that helps. This is more about teaching you guys, though, not about me, but thanks for asking. And we already went over EBITDA as well.
I have a feeling that a lot of them are thinking, oh, do I have to learn this or can I just hire somebody to do it for me?
I mean, hiring somebody is much easier. You just want to make sure that you've really, you've put it in your budget, you understand the costs. You know, don't scrimp when it comes to your financial management, because that's one area that you can really go backwards if you don't understand and your financials are inaccurate. Because I find that a lot of bookkeepers, the reason they're keeping your books and they're not doing financial analysis, if they were a controller, they'd be called a controller, is because they're literally just putting everything on your P&L. They're putting it into buckets. They're not focusing on your balance sheet, and they're not helping you build wealth. And putting things on your balance sheet, understanding how your balance sheet operates, is how you start building wealth and equity within your business. And if you're just expensing things and you're just not paying attention to it, you could be missing out on a lot of things. And one on the flip side, on making sure your financials are accurate, a lot of people think that they're really profitable. And let's say they have 20 employees and they give them all 2 weeks of paid time off every year. I can't tell you how many businesses don't do accrued paid time off on their balance sheet. And if they had all 20 people were to leave, something were to happen, they might have $80,000 in liabilities that they never put on their books because they're not paying attention to it and they're doing cash accounting. Now, I never recommend cash accounting for any business, because there's prepaid expenses, there's prepaid dues, there's so many prepaid things that go on. There's a lot of accruals that you need to focus on. So here's some basic ratios to move on. Again, another meme. Some people try to kind of play with the numbers a bit, manipulate the numbers, and you don't want to do that. Even if the colors are prettier the other way. I mentioned current ratio. That is all your current assets and divided by your current liabilities. Ideally, you are 1.25 or higher. And that if you're less than 1.25, make sure you have a plan to get to 1.25 or higher. Quick ratio is the exact same thing. You just take out inventory. A lot of people have all this old inventory on the shelf and they're valuing it at what they hope to pay. I hope somebody's going to pay for it. But oftentimes, I mean, even let's talk about cheese as an example, right? You have $40,000 worth of all this specialty cheese. Well, what if it gets too hot and all your cheese goes bad, right? Then your quick ratio and your current ratio become very different. And so managing inventory, not having anything spoil, not having anything become obsolete, really understanding what is the true value of my inventory, and don't underestimate what that means, because if you overvalue your inventory and you're just knocking on wood, hoping that inventory is going to be valued at what you think it's going to be valued at, you might be in for a scary wake-up call when it's worth half or less. So we've had some real big issues with clients like, where's this inventory? Have you done an inventory count recently? Oh, we did one last year. Really? Well, we don't see the inventory. Where's your, and it's walked out the door and they haven't kept track of it. People have stolen from them, or it's gone bad, or it's not obsolete. It's obsolete now. So I don't want to run on about that, but it is something to really focus on. Days of sales outstanding. That is another one that can cripple you. Absolutely cripple a business if you are not focusing on your days outstanding. That means you have become the bank. You are now giving your clients or your customers money for very low, no interest, right? You're basically 45 days, 60 days, 90 days. That is very dangerous. Our DSO at Optima, we're about 18 to 20 days. That means our customers are with 300 companies paying us on time. That's what that means. So get into ACHs, get into credit cards, do stop works. I'm not going to send you the inventory. I'm not going to send you the product or the service. And people want 45-day terms. Well, then charge them an interest rate for it, or, charge them some kind of a premium, and maybe you give them a little discount if they pay on time, but you certainly don't want to become the bank at no interest, especially with interest rates rising right now and where the economy is at and the demand of products and services. You want to make sure that you're really focusing on what your days outstanding are. And you can just take your inventory of your accounts receivable number right this minute and divide it by your average daily credit sales. So what does your business make per day? Mine is almost at $40,000 a day is what our revenue is. And so if I take my accounts receivable number and we're at 200,000, and we are making 40,000 a day. What does that mean? Right. So just make sure you do the math in your head and you understand what your days outstanding on your AR is. I'm gonna give you a really quick tip, and I promise it works. It seems kind of funky, but you can buy pink paper, go to the store, buy pink paper, and you can physically mail out your invoices on pink paper to your customers. Accountants hate colored paper. We do, because it messes up our whole stack. We have all this white paper everywhere, and you send us a pink slip when we're late. Accountants generally want to get that out of the stack. You can do yellow as well, but pink is a little bit better. It's just obnoxious. I don't really like the color pink, but it's just an obnoxious color sitting there in their stack, and they start getting a pink invoice and like, oh my God, we're in trouble. And so they will send payments out faster if you send it to them on pink paper. If you want to be really bold, go buy a red past due stamp and put red past due on the pink paper, physically mail it out with a stamp. You would be shocked at how well that works. I'm not going to go over book to bill. You can read it, but it's when you have a lot of backlog. And in this market, if you have backlog, people might go somewhere else. So make sure that you can fulfill on your products and services. And for those of you that have inventory, you're going to take your cost of goods sold divided by the average inventory value that you have on a daily basis. What is my average inventory? And you're going to divide it by your cost of goods sold. I usually recommend an inventory turnover about 30 days or less, but it really depends on what you're selling and how much your product costs. If you have a $50,000 product, maybe 30 days isn't reasonable. Maybe you have a 90 days. You want to keep that product. You're selling, I was going to say Teslas, but those are flying off the shelf so quickly these days that it wouldn't be on the shelf for 90 days. But, let's say you have a high-end, product that you're selling, maybe having that on the shelf longer might make sense. But if you're selling widgets or cheese, you want to get that off the shelf quickly. We did have a deli as a client. That's why I'm using the cheese example, because they really did have some issues with cheese and inventory. It's a real thing. All right, let's kind of switch gears a little bit and talk about what you need for your small business or your startup in terms of bookkeeping. The very first thing you're going to do, I understand many of you, especially some of the smaller startups, they're just getting going. You're going to just put things in Excel. If you're just using Excel, just code it correctly. Make sure that you have the date, the name of the vendor, what the cost was, and then put a category. What was it? And generally speaking, if it's over $1,000 cost, you might want to consider putting that on the balance sheet as an asset. It's called a capitalization policy. Some people do 1,500, some people do 5,000. It's really going to be what makes sense for your company, but be consistent. But if you are ready to switch out of Excel or Google Sheets and you want to put everything into an accounting software, you're going to want to do that before you file taxes anyway. I mean, unless you're talking $500 or something, then the CPA can figure it out themselves. But if you start getting hundreds of thousands of dollars in cash going in and out, you absolutely need to move to an accounting software, something as simple as Xero or QuickBooks or FreshBooks. QuickBooks is pretty low cost and it's very standard. I would probably do even just a QuickBooks Online account. Once you get into the bigger systems, you've got NetSuite, you've got Sage products. Sage has bought up a ton of the other software. So you've got if you're working in the government, you might have Deltek, you might have Uninet. There's just so many other softwares out there. So just pick a software, make sure that you have some kind of don't use your personal bank account. No commingling. Open up a business account. I don't care if you put $100 in there. Make sure that you are having a separate business account instead of personal. You can record shareholder loans, shareholder contributions. Just don't mix your personal and your business bank accounts. That is a recipe for disaster. Us accountants, you drive us crazy when you do that because it takes us a ton more time. And then you complain about your invoice because, oh, you just spent 2 hours. Why did that take 2 hours? Well, because you put a bunch of stuff of your personal account. You put that on your business account. We have to separate it. That takes time. So if you want to save yourself money, get a business bank account. Ideally, you can get a line of credit. You can get even credit cards, whatever you can use to finance your business. And if you need to lend your company money, great. I lent my company a ton of money when we first started, but I have a shareholder loan on the books. That means I take the loan out, I take it back when we have extra kind of cash, or you take the loan money back. But even if it's $2,000, put the $2,000 into your business, record it as a business loan. the offsetting entry would be cash. A chart of accounts is really important. I always like numbers on our chart of accounts, because if you're just putting words down, that's okay. But accountants are really more organized when you put associate numbers with your chart of accounts. So the 1000 series is assets, the 2000 series is liabilities, 3000 series is equity, 4000 is income, 5000 is cost of goods sold, 6000 is operating expenses, 7,000 is other income and expenses. So you want to follow that. That is standard. You're not going to see a company out there that's going to use a 2000 series for assets or the 4000 series for liabilities. If they are, send them my direction, because we'll fix it. We've seen some really messy chart of accounts, and they're not organized or hard to follow. They're jumbled. They don't make sense. And it's going to do you a huge disjustice when you're going to read your financial statements. So make sure your chart of accounts makes sense. Then track your sales. Hopefully we all have a bunch of sales in the room quickly, right? You're entrepreneurs. You want to be successful and have revenue. So make sure you're tracking that revenue as definitive as possible. So if you have 5 products, maybe your chart of accounts need to have 5 different line items in there. If you have 3 service lines, then separate it out. Make sure you separate it out by customer. So when you're using QuickBooks, if the same customer is going to be repetitive, you want to record that customer. If you're going to have a bunch of one-time uses or one-time people that are buying your product or your service, then you don't need to record it by customer. But if you're trying to track some more, if you're trying to track things a little bit better, you want to try to be as specific as you can and as detailed as you can with your sales. When you're looking at your business expenses, determine whether it's cost of goods sold. I've already gone over this, so I won't repeat myself, but make sure that you really understand the difference between fixed and variable and what goes to your cost of services and what does not. I already said this a couple of times, but really make a conscious effort to know what goes on your balance sheet and what goes on your P&L. And if you are glazing over and you don't want to know, then hire an accountant. Bookkeeper, hire somebody, but don't just hire, if people make the mistake of just hiring a bookkeeper, and that bookkeeper is not going to be good at your financial management ever. They would not have a bookkeeper title if they could do financial management well. So they are going to be able to spit out a P&L and a balance sheet. If it's accurate, I don't know. I would probably say even a controller 4 hours a month is better than nothing, because you have somebody that's higher level. Even your CPA, if your CPA can vet it, have somebody that has a strong financial accounting acumen really vet and bless your financials on a monthly basis. Yes, hire a professional when your financials monthly. And then again, make sure you record paying yourself. Guaranteed payments are for LLCs. So if you start an LLC, you can't pay yourself a salary. You have to pay yourself a guaranteed payment. If you have an S corporation, you can pay yourself a salary. Of course, you'll want to pay yourself a salary. It's no longer called guaranteed payments. But one of the things with S corporations to be conscious of, if you have 3 partners, let's say you're 33, 33, 33, you each own a third of the company. When you are an S corporation, you have to have equal distributions. So some businesses do not want to become an S corporation because one partner might be putting in money, but not any sweat equity, and the other people are putting in more time and effort. And so they might deserve a bigger distribution, but you can't do that with S corporations. S corporations distributions have to be equal. Salaries do not, but you cannot pay yourself a salary. You cannot be a W-2 employee as an owner of an LLC. So it's getting a little bit more high level, but just something to note. Make sure you hire a good CPA. More questions?
Yeah. Sorry.
Yeah,
Let me
no.
ask, how much in average is the cost of your accounting service for a startup?
We have about a $500 a month minimum, but I have a lot of great referrals. And so if you are a startup business and you need help, I have a lot of great bookkeeping firms that do have a little bit of high level support and low level support, and they can help you. Our minimum's 500, but that does get you, 8 hours a month of bookkeeping and 3 to 4 hours of a CFO or controller, somebody that's helping you, which is a drop in the bucket, depending on how you look at it.
And then someone asked if you guys have your own accounting software.
We use every single one out there.
Oh, okay.
We have a bunch of cloud servers. And so we do QuickBooks Enterprise on the cloud. We have wholesale QuickBooks licenses that we give discounts to our clients because we have so many of them, we can get discounts. But we do a lot of NetSuite, Sage Intacct. We do Sage 100, Sage 300. Uninet, Deltek, Azera, name a software, Great Plains, Dynamics, SAP, Oracle. If you're financial, using nonprofits, right? A lot of nonprofits use MIP, Financial Edge. Some still use QuickBooks. So there's specific not-for-profit software that actually tracks donor activity, those types of things. So we inherit whatever the customer is using. And if they don't have something, then we'll pick one for them based on their cost. For example, if somebody has inventory, NetSuite's going to run them a couple $100,000. And that can be expensive to maintain, but it's the cream of the crop in some aspects. And so if they can't afford that, we might give them Acumatica, because Acumatica is a great software. It still does inventory well, or you get an inventory plugin that works with QuickBooks well. But make sure QuickBooks does not do inventory well. I'm losing all my things here. Yeah, QuickBooks does not do inventory well. So be very careful if you have a lot of inventory and you're trying to use QuickBooks. You have to have a separate schedule because it'll only do average cost. And so in a market where costs are increasing, you don't want to just use QuickBooks because you want to know exactly what those costs are going to be. So first in, first out, last in, first out. I'm sure you've heard this in class. QuickBooks will not do that ever. The best QuickBooks in the world will not do LIFO, FIFO. They only do average weighted. Things to know. Anything else? Okay. Yeah. All right. Budgeting. Who wants to make a budget? Start with your sales. What do you think you can sell? No, in all actuality, you probably want to start with your fixed costs. And then, what is my break even, right? You want to make sure you're at least breaking even. So what are your fixed costs? What is a bare minimum, including paying yourself, that you have to have in order to make $1? And then back in how many sales you have to have. And so I like to get somewhat detailed on a budget and really record it sometimes by vendor. Who are the vendors that I need to pay? What bucket should they go into so it can all roll up properly? So the more detailed that you can be with your budget, the better. That way you just really know the score. And keep your budget the same every year, even if you find that you were way off track. You can always do a reforecast, but always keep that original budget in mind. So you know your thought process. Why did I do that? Because if you're constantly changing your budget, then it makes it a little harder the next year to do a budget again, because you're not really taking it seriously. You're just continually changing it. So I would recommend maybe doing a forecast that's changed, but having a budget tool and a forecast tool. You can have both. We have both because we're going to do a little over $1 million more than we thought we would this year. And so now we have just like a $10,000 Padres game that we're spending on. That was not in the budget. So we're going to be over budget on some of our expenses, and we're going to be way higher on some of our revenue. And hey, our budget wasn't very perfect this year. We didn't expect to have another $1 million plus in revenue, but boohoo, poor me, right? Now we have money to spend on fun stuff. So, but always know why you came up with that budget. So I don't like to read slides. You can look at why the budget is a good tool. They're fairly self-explanatory. So I'll move on. Hopefully you've taken a picture of it, screenshot it. You have my slides. They can have these. Fine. Yeah. These are original. I didn't copyright them. Take them, print them, share them with your friends. It's got my logo on there, so that's my own copyright, right? I'm going to move on to cash flow, and then we've only got a couple of slides left, and I think I'm somewhat 250. All right, I gotta hurry up here, but hopefully we've been asking some of the questions as we've gone. Let's talk about cash flow. I don't care if you make $5 million a year. If you spend $5 million in one, you're not profitable, right? So that's just a basic concept to make sure you're profitable. Understand you do not want to run out of money. We have seen horror stories of companies who run out of money and they can't pay their staff. And that is an employee, that's scary. Oh, we'll give you your paycheck in a couple of days. Oh, sorry, we're trying to figure out financing. You always want to try to get financing when you don't need it. I have a $250,000 line of credit. I don't think I'm ever going to need it. We've got plenty of cash, but I have it in case I need it. You never know. And so always have, even if it's a $10,000 Chase card or Capital One card or whatever card you use, have some extra capital on hand ready to go because you don't want to run out of money. And again, think of everything you're going to spend cash on. All right. It's not just your things that go on your P&L. It could be debt service payments, credit card payments. It could be, interest. There's so many other things that you can spend money on that need to be recorded in your cash flow forecast. And a couple slides, I'll give you a template as well that you can use. I can send it to you in Excel too, if people just want to use it as a template. I think I already kind of went over some of these. I'll let you all read this just real quick. I don't like when people do presentations and they read slides because that's almost condescending. It's like you guys can't read yourselves. So you can read. Feel free to ask a question though about what you've read. Again, don't run out of cash. That's never a good thing. We don't want you to run out of money. I always like to make sure that my cash flow forecasts have a 13-week. So what does your 13-week look like? 13 weeks is a quarter. So from quarter to quarter, how much money did you start with? How much money are you going to end with? And you can reforecast your cash all the time, but you might want to know originally how much money at the beginning of the year you thought you were going to have at the end of the year. Do the whole year, but then focus on each quarter. You should probably do your cash flow daily at this point in your entrepreneurial venture, in your journey. Maybe it's every 2 days, maybe it's every 3 days, but I would not wait a month to update your cash flow forecast unless you've got 2 transactions going out every month, then fine, do it monthly. But we do ours daily just because it's a lot to keep up with if you don't. You always want to have, oh, go ahead. Yeah.
So quarterly would help too if you have sales tax, right? Because you have to pay your sales tax.
Right.
So you might as well just keep it
And
standardized.
yeah, exactly. Yeah, you want to think these are all the things you want to think about. If you've got quarterly sales tax, you've got obviously your payroll taxes have to get paid every payroll period. Some people do their 401k annually. It just depends on the business. And then always make sure you have a second set of eyes on your cash. I can't tell you how many businesses get stolen from and how much fraud there is because people aren't keeping an eye on their cash. They don't have a second set of eyes. They hire a bookkeeper. They let them record everything. They let them print out financials. They let them do payroll. They let them do deposits. And that's just basically your biggest asset is your cash. And you're just giving it to someone with no second set of eyes. It's in this day and age, you really can't do that unless it's your sister or your husband. But then again, are they a qualified bookkeeper? Do they have an accounting degree? Just be careful. You always have a second set of eyes. What else?
I have a question, Jennifer.
Yeah.
If you don't have a lot of money, you can only afford to have one accountant on staff.
Yeah.
Are there any other things that you could do to minimize the chances of theft or?
Yeah, look at your check register every single month. Look at what's being recorded. Look at your bank balance and make sure that if you print out your bank reconciliation and your credit card reconciliations, you might just want to every month compare it to your statement. What was the beginning balance entered correctly? Are the checks outstanding really still outstanding? Are there any undeposited funds? What's being deposited? What's not? A big area where people have a lot of theft is payroll. And so you want to make sure that the payroll numbers are really truly matching. Look at the payroll registers, which is what's going out of the bank account. So if they say $40,000 is going to go out of your bank account on your payroll register, go back to your payroll register and really look at, okay, who's getting paid? How much are they getting paid? Are the payroll taxes calculated correctly? You'd be shocked at how creative people get to steal.
You know, the one time it happened with me when I had an accountant, I didn't realize that she was stealing until she went on vacation. She never wanted to go on vacation ever. And then I figured out why.
You know what's interesting? I can almost call it when somebody calls me and they say, I've got a tricky situation. My bookkeeper is getting me financials late. They're not giving me reports. And every time I go to ask them a question, they're really mean. It's almost like they're the onboard terrorist. The more onboard terroristy your bookkeeper is, the more likelihood they're probably stealing. And there's a reason that they're angry, the reason that they're defensive, the reason that we've seen it a lot, unfortunately. People just get creative. They have that and they're entitled to it. They deserve it because you have it. They think they deserve it too. And so they'll just take it. They'll find a way to take it. You also want to make sure you have accurate financials and cash flow so that you can get a loan. Banks want to make sure that you're really keeping track of that. So then they know, or investors, when they're going to get paid back.
I think they call that keeper of the keys syndrome.
What about like your company having a company credit card? Have you seen that?
Yeah.
Okay.
Yeah, but you want to set minimums or maximums. You want to say, what are people spending and why are they spending on it? Have a policy. I think David was chiming in, but maybe it's in chat or,
He was saying thank you for the slides.
Oh.
And Yolanda as well.
oh, okay, cool.
I
can
just said
kinda
that.
hear it
I
after,
think
like,
I think they call that keeper of the keys syndrome when the
Oh,
accountants are act like that.
okay, and then this is the last slide. I just wanted to give everybody an idea of what a cash flow template looks like. You want to put in how much cash do you have in the beginning? And then you want to put in all your collections, how much money is coming in. Then you want to put in, what's your balance prior to spending, and then put in, I like to do this by payroll. I really think that if you have a payroll and you can do your cash flow, you can do it weekly. You can also do it by payroll. I tend to like doing it by payroll because those are our biggest expenses. And so I want to say, okay, when the payroll period ends, how much cash do we have left? I'm still doing it that way. We have a $330,000 payroll going out on the 10th, which is like tomorrow. I don't know, next soon, Monday. So I want to know, okay, I have $330,000 going out of my bank account on Monday. Where are we at? Fortunately, we made payroll. Yay, we're fine. But I like to do it by payroll because it's just, it helps make it a little bit more succinct. Oh, Tuesday. Okay. We got Monday too to get more money in. Oh, okay. Oh yeah. Yeah, Mother's Day. I've got I'm gonna be a mother soon. 3 more months. Oh my gosh. Yeah, I'm not overweight. I just I've got a basketball in here. He's already 2 pounds. I know. Mason Barnes due in August. I'm 42, so they say I'm a geriatric mom. It's okay.
Aw,
I'll give it that.
congratulations.
So
I
just
had
know
my
the
daughter at
categories are going to be
42.
different from everybody. You may not have a 401k, so obviously don't put that number in there. You might just have contractors. You might not have health insurance. There's just make sure these categories make sense for your business. It can be all very customized, but just keep track of it. Yeah.
In a small business, of course, they're small, right? Do they offer or give their employee health insurance?
You actually have to provide health insurance now. I believe it's over 25, and if you have more than 25 employees, I know you have to do a 401k now. Depending on how I think it might even be like 5 or 20.
No, it's 20.
20 employees. Yeah. Once you have 20 employees, you have to have a 401k plan. So I've had one since day one, but also my main vision is to have the highest retention in the industry. But it's you want to just make sure you talk to legal. When you set up a business, you want to have good legal counsel. You have to have a good CPA. You want to kind of think through all the expenses and just risks, compliance.
Yeah.
You don't want to be in a risky position. And you want to make sure that you're really focused on who's a 1099 versus who's a W-2. Government, they were really cracking down. You will have to pay back taxes and fines and interest and penalties and everything if you misclassify. So I cannot have a 1099 in my business unless I hire them to paint the wall. Right? I hire them for catering. But if they're doing accounting or HR or operations, I cannot have them as a W-2. I mean, I've got 1099. I have to have like 90 W-2s right now. There you go. That's it.
Jennifer, can you hear me? No? Okay.
Chart of accounts. You can probably download some templates. I would say think of you're going to want to have cash. You're going to have accounts receivable most likely. You might have some fixed assets. Other assets, what do you own? Like what do you have that's something you could sell? And then you might have inventory. You're going to have accounts payable. You're going to have accrued expenses, some accrued liabilities. You're going to have equity. You might have shareholder loans, distributions, contributions, and then just go through all of your cost of goods sold, right? You might have payroll. You're going to have marketing costs, professional services. They should think of all, when you're putting together your budget, assign a number to each of the line items on your budget. And then go to the balance sheet and then start assigning, what do I know I'm gonna owe versus own versus equity, and then assign a number to it. And again, I think in textbooks, it's easy to say the 1000 series is assets, right? It's very standard. It doesn't change. It hasn't changed. And I don't know if it's ever been different. Not since I was born.
Not since I
Again, I'm
thought.
42, so in 42 years, I don't see the number series hasn't changed. So,
Yeah. See, you can tell that you really know what you're doing too, because you're just rattling out everything that's on it. I have to teach this stuff. It doesn't come naturally to me. And so I'm always, okay, let me check. Let me see. It's great. You definitely know your stuff.
22 years of being an accountant.
Yeah.
I don't do a whole lot of accounting anymore, but
Yeah, but other people do.
it's built in my blood.
Right. Well, thank
All
you
right.
so much
Yeah,
for
you're
being
welcome.
here.
Sure
And
thing.
appreciate it. We have cake, we have snacks for people here. At home, if you want to stay on, if you have any questions, we'll keep the chat going and for a couple more minutes. And I want to thank everybody for being here, and we'll see you all the next one. Bye, take care.